Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hello, welcome to BankTalk. I'm Rich Carty, sales executive here at Remedy Consulting. Today, we're going to have a repeat guest on after 2 years. We're lucky to have Zach Zoya, managing director at Darling Consulting Group, join us. He also is the co-host of DCG's On the Balance Sheet podcast. So lucky to have him here. And we'll talk a little bit more about what's going on the interest rate side, liquidity, and maybe some capital analysis of today's markets. Obviously, a lot going on here, middle of April as it is today. So thanks for joining us, and hopefully you enjoy it.
Rich, it's a pleasure to be here. Thank you for having me.
Yeah, Zach, thanks for joining us. I appreciate you joining us here today on BankTalk too. I know you're busy on your side, and you have your podcast, but 2 years later, here you are again to talk about the wonderful world of risk within the banking industry.
Yeah, and things keep changing, right, Rich? I think that's the fun part about this business. There's always something going on. Rates are moving, events are happening. So I'm looking forward to getting into the questions.
Absolutely. Well, let's remind our audience, for people who maybe didn't, hear of your podcast in the past, or talk a little bit more about DCG and maybe your day to day.
Yeah, Rich, I'd be happy to. So first off, I'm a consultant here at Darling Consulting Group. So we work with community banks and credit unions throughout the country, really from the asset liability management side. So a lot of what we do is strategy and advice, trying to really improve banks and credit union performance, but also manage those risks, right? And it comes down generally to liquidity, capital, and interest rate risk, which are really the three pillars that I work on with my clients. I have about 30 clients myself, and we have about 14 of us in my group. So we're touching 350 plus community groups every quarter and helping them run their asset liability committee. So it's really a fun kind of place to be. And then we're lucky enough, myself and my colleague Vin Clevenger, who's also a consultant. We have the podcast you mentioned, On the Balance Sheet, which you can find, Apple, Spotify, et cetera. But it really highlights what we're trying to do is talk to our clients to talk about their backgrounds, their relationships, how they've kind of grown up in the business. And we'll talk about key issues as well. We'll bring on economists every once in a while too. But a lot of it is trying to get, bankers to hear what other bankers are up to and where they've been.
Awesome. And obviously a lot's changed since you were last on a couple of years back. So, we're again in the middle of April 2026 today. Back when you were on in 2024, the industry was really in the midst of a quick Fed hiking cycle, challenging margins and income levels. Rewind now to 2025, we saw some margin recovery and expansion. Let's go back to January 2026. What were the expectations for this year, and what do you expect to continue there?
Yeah, Rich, absolutely. As most of your listeners, I'm sure, who are bankers know, the net interest margin, or kind of the net interest income stream, is how most community banks make the vast majority of their money. Right? They're not J.P. Morgan, or they're not Wells, right, with active capital markets groups and broker dealer arms and things like investment banks. Right? So the margin is really important. Back in 2024, that was a challenging time. Kind of coming out of that 2022-23 hiking cycle, and you saw margins contract, in the industry. And the good thing is that what we've been seeing, and what most have experienced over the past year, like 2025, you can look at FDIC data, or you can look at our own data. Margins are up about 33 bips, per the FDIC. Asset yields up about 9 basis points. Funding costs down about 23. So over last year, we saw some recovery in terms of margins going higher, and they're finally really at levels now that they were at the peak or kind of right before the Fed really started to hike, right, in 2022. Yeah. So we gave maybe 40, 50 bips back in the industry over the last couple of years, and we're finally pulling out of that. And what we've seen too, interestingly enough, Rich, is that NII, right, net interest income, if you want to put into a number, is up about 17% amongst our client base last year. Spreads are up 31 bips, so it's kind of similar to what the margin is with the FDIC. It's a similar kind of pairing here with asset yields were driving part of it, but the funding side was definitely the tail wagging the proverbial dog over the past year, as I think a lot of groups were able to cut funding costs, with the Fed cutting 175 basis points during that time. So the funding cost has been a big relief, kind of lever here that the groups have pulled, which brings us to this year, which if we started back in January, there were a couple Fed hikes priced in. I think people's budgets were looking at a couple cuts, and things have changed a bit, I think, since then. But our models, through today, right? So take rates out, agnostic on rates, if you kind of keep them where they are. What's changed here, Rich, is that a lot of the recovery I just mentioned has been pulled forward, meaning we've already gotten a lot of that relief. So our models, what we're seeing, if last year was a 17% hike or increase in NII, we're seeing about a 5% projection this year. So about a third, right, of what it was last year. Spreads are up about 20 bips. And what's interesting is the asset side on a projection basis is now the lead. The funding side is really kind of plateaued, give or mostly. If the Fed stays where they are, there's not much more meaningful relief. So now it's turning from funding being the driver to now the asset base is becoming a much bigger driver with all those loans and bonds that were bought in 2021 and 2022 and 2020. Those are cash flowing more. They're prepaying a bit. You get maturities on those. So those are now repricing higher, which is driving some of the benefit that we're seeing. So if I were to summarize that long-winded answer, there's still some margin tailwinds that we're seeing, but they're not nearly as strong as they were last year.
Okay. Well, with the asset base being the driver for 2026 and the funding costs, like you mentioned, being a little less influential, would anything change that?
Yeah, how much time you get, Rich? About a million things, right? Could probably
Pretty
change that.
Pretty open-ended question, but yeah, I mean, maybe give us a few bullet points.
No, it's a great question. I think that's what we're trying to do. So I mentioned before, we help groups with their asset liability committees and their risk models, and I think that's the key, because what I just went through relatively quickly was the baseline, right? It's a baseline, rates unchanged. Here's the projection. Most banks and most credit unions look good. So do we stop there? No, right? We have to kind of sit back and say, okay, well, what might cause this projection or these models to trend differently, right? So I think your question really hits the nail squarely on the head, which is, what should I be worried about if I'm seeing NII going higher and the models start looking good? What should I be preparing for? And I think the biggest thing that we're seeing right now, Rich, is the asset side is the driver. But what if yields aren't coming through as high as we think? And what I mean by that is, you got a bunch of loan cash flows coming off. The average rate is 5%, let's say. It's coming back on. You're writing loans today on average at 6.25% on average. So great, that's 125 bips of pickup. That's causing some nice margin expansion here. That's terrific. Well, what if those loan yields on average are more like 6? What if you take a quarter off that because of spreads are tightening, or because yields have come down a little more than what we thought, or maybe everybody wants volume and everyone's fighting each other for the best loans, and that's driving pricing lower. So I think number one is the asset side, just fundamentally, if we're seeing those yields come in lower than we expect from a variety of forces, well, that's going to dampen that tailwind, right? That's going to slow down that expected, we'll call it expansion or accretion of margin. And we're definitely trying to help groups quantify that, because I think that's really important. The other piece is, a lot of the models we run, they're static in nature to start, Rich. So we try to keep things steady and stable. We're not trying to put tons of growth in. We're not trying to put in tons of different variables that would change that mix as a starting point. We still want to do those, right? We want to run a ton of scenarios that are more dynamic to absolutely quantify that. But a lot of groups in their base models, they keep loans flat. Okay. Well, what if loans aren't flat, right?
Yeah.
What if there's contraction? So to me, it's kind of two-headed. It's, what if the asset yield side is not nearly as strong as we're expecting because of some of the things I just mentioned, but also, what if we see contraction? What if there is a loan growth? And I have clients who in some parts of the country have plenty of loan growth, others who are really fighting for it. And it's a real problem. So I think those are two areas where I want to run what ifs. I want to quantify those on my models to understand what those might look like from a more dynamic perspective. So I think, Rich, those are two top of
Okay.
mind. Certainly, and obviously within that, you can probably construct a, hey, this event happened or this event happens and rates move and it affects these two variables. But I think this is where, like, no matter what happens, if these variables I think are very, very critical. And I think the
Yeah.
next piece of it, just to round it out, would be obviously if rates move more than we think. So I mentioned the base projection is rates flat. Well, what if we get a lot more Fed cuts this year?
Yeah.
Right now, the markets have zero priced in this year. So if we get more cuts, you know what's going to change? The funding side is going to be a lot more important to the
Yeah.
margin if we see cuts. So now I mentioned that the funding side is kind of plateaued or it's really slowing. Well, if the Fed starts cutting again, game on. We're going to have to kind of reinvigorate that falling rate playbook again to get some funding cost relief. And on the flip side, what if the Fed hikes? I mean, I'm sure you saw this in the news and in the listeners too. But after the March Fed meeting, the word hike was thrown in there right afterwards in terms of what if we see a hike later this year because of the inflation concerns, given the war and things like that. Do I think that's probable today? No. I mean, it's not likely. It's not priced in the markets, but I want to know, right? What might happen if we get a couple Fed hikes here or an up 100 or up 25, whatever it is. What does that mean? How does that change kind of my trajectory? Right. So I think that at the core is we're trying to help folks understand that range of outcomes to understand where they're most exposed to, but also where they're most benefited by.
Yeah. That's interesting and makes sense. Clearly, the yield curve changes will be impactful on pricing and margin expectations. Maybe talk a little bit more on the degree in which rates have moved recently and maybe expectations in the near future.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
No, I'd be happy to, because this, I'll give my disclaimer to those who maybe aren't familiar with our firm, but we don't have like an economist on staff. We aren't a fixed income shop. So anything I say here is I'm reading probably the same things you folks are reading and trying to parse through it. We're generally agnostic to rates, but I think what's really interesting, if you were to pull up like a treasury graph and look at the end of 2024 to the end of 2025, a year when margins really expanded, to your first question, that actually happened in a scenario where you look at like the Fed was down 100 then, but the other parts of the curve that are pretty influential on bank lending and asset pricing is the 5-year point and the 10-year point, right? Depending on your, if you write a lot of mortgages, you do a lot of commercial real estate, et cetera. So I mean, in those parts of the curve, we're down more like, we'll call it 65 bips in the 5-year, or maybe 40 on the 10-year. So we saw some curve steepening, right? We saw the short end move down more so than the long end. And the short end really impacted funding costs. The long end certainly had an impact on lending and asset, yields, but it wasn't as impactful, right? So that's what caused some margin benefit. I think what's interesting here, Rich, is if you were to look at the year end to, let's pick February 27th, the Friday before the war started. You had private credit concerns. You had some noise in the markets where that yield curve, that 5-year point dropped another 25 bips. So really you're talking almost 90 plus basis points of reduction in the yield curve from the start of 25 to right before the war started. So that's a pretty meaningful move, right, in a 14-month period overall. So
Right.
the expectation, though, was that we're going to see a couple more Fed cuts this year. And
Yeah.
since the war started, really, and I'm using that as a there's a million things going on, obviously, but I'm using that as a pretty important event that's out there
Yeah. Yeah.
going on is that curve has backed back up overall, and we've seen that curve jump back up a bit 40 to 50 basis points in that long part of the curve. Now, the short end of the curve hasn't moved at all. The Fed hasn't moved in this time frame. But we've seen some volatility at the long end of this curve. And why it's so interesting to us is because this has very meaningful impact on bank and credit union deposit pricing
Yeah.
or loan
Right.
pricing, depending on what sector you're in or what you're doing here. So I think the volatility, you've seen moves here, maybe it's, we'll call it 40, 50 basis points lower, or actually probably even more so, right, overall. And then we're picking back up another 40, 50 basis points. So we just see big movements here overall. And I think right now the markets are trying to figure out like what exactly is going to happen in the future. So the curve is a lot flatter at the front end because the Fed's on hold, right? So the
Yeah.
Fed is saying we don't know what's going to happen necessarily, but inflation is higher than we would like. Oil prices and the impacts of that aren't helping, but maybe the labor market is a bit softer than we'd like. So they have this dual mandate, and they're really between a rock and a hard place. So it looks like, just again, from what I'm looking at, it's the Fed's on hold for now, and the long end is just really trying to handicap what exactly is going to happen outcome wise with the war, with private credit, with the economy, with unemployment, all these types of things. And right now, what it's saying is that if the Fed's on hold, and we've kind of sat in this range here where that 5-year part of the curve is sitting, 375 to 4%, the 10 years is sitting in that kind of 425-ish range. And we've kind of been there since the last 6 weeks, give or take. There's been a little bit of volatility, but it just seems like we're in a holding pattern and we're kind of at the whim of some of these geopolitical events for the near term.
Yeah. I mean, look, from today, that's 2 months ago almost. And like you mentioned, February 27th, we were supposed to do a presentation. A snowstorm wiped us out, actually, on mergers and acquisitions. And we just did a podcast, or I think our last one we put out was M&A. But it's funny because a lot of what we were going to do in this February presentation, which we just ended up rescheduling for last week, was kind of changed because of obviously the events over in Iran and with the war, where there was a lot of positivity, there was optimism to start the year. And then now it seems like there's a little bit more of, all right, it's a yellow light. We're not full green light right now. Let's just kind of see what's going on. Maybe stem on that a little bit more with the recent geopolitical events. How should bankers maybe be managing the volatility in the yield curve? And what do you think institutions are thinking about in terms of positioning and maybe their appetite in that sense?
Yeah, absolutely. It's a great question, Rich. And I think the M&A piece is interesting too, because there's certainly been a lot more deal flow and it's been quicker to get through and approved, in the last 15, 18 months than there was before. Right. So I think one thing is I've used the word, with clients to kind of be opportunistic. And I certainly don't mean we're here to time the market and be transactional. But I think what it comes back to is like know what you need. And what I mean by that is you have a balance sheet, you have models that you run a ton of scenarios, you get a ton of assumptions, you've done the right work, and you understand where your risks are and where the exposures are. That's the hard part. And so now that you kind of know where you're exposed, if you know what you need, you know that what your goals are, and you're looking, let's say, you're liability sensitive, meaning you have some exposure to rates going up, but if rates fall, you do better. Well, if we get a situation where the yield curve does what it did back from year end to February 27th, insurance for a group like that, whether it be like putting a swap on, pay fixed swap, or whether it be a borrowing extension or things of that nature, like that became cheaper, right? When you saw a 25 bip sell off, sorry, rally, in the curve through the first kind of 6 to 8 weeks of the year. Did you pull the trigger on things, or did that make sense for those groups? And then conversely, like you see the sell off here, the 50 bip sell off in the last 8 weeks, we'll call it. Maybe that's a better time to, you've been pre-investing bond cash flow. Maybe you do a little more
Sure.
because, it's tactically speaking, it's a little better environment, and you're not going to time it perfectly. That's certainly not the goal of what we're doing. But I think if you know what you need, like the best groups I have, it's fun to talk about geopolitically what's going to happen, and let's project and forecast and talk about where rates are going to go, but no one knows really, right?
Yeah.
Overall. So it's like, let's know what you need. Let's not panic. And when things go on sale that we may need, let's do a little bit of those. And when things aren't on sale, maybe we do a little bit less, and we just keep being programmatic about it. And that's the kind of the best advice I have. Not, from a generic perspective, obviously specific bank and credit unions will have their own specific things that they want to do. But I think that at a very macro level is what we're trying to, in part, is be opportunistic, know what you need, and let's not panic. And then from
Yeah.
there, okay, now we get back into the really kind of the blocking and tackling pieces of loan and deposit pricing. Right now becomes more important than ever when rates are bouncing around. And I think the discipline that groups need in terms of how they set their loan pricing, what they're doing from the deposit side, the data that they need, and kind of the management of that, to me, just
Yeah.
the groups that do that really well, I think, have a leg up because they can react faster, or they can be, I guess we'll call it, proactively more reactive. They're ready to go when they need to go. And I think that's a key, is because if you're reacting to every single volatile move, whether it's on the wholesale side or whether it's on the loan and deposit side, you're just going to be one step behind. So you got to be ready to go and know what you're going to do before some of these things happen. And then when they do happen, now you have that game plan and you're ready to strike.
That's interesting, and it just makes me think. Like, I'm going to put you on the spot here and play a little game, Zach. So,
Sure.
let's say hypothetically, we finish our podcast, and all of a sudden we have breaking news. We have peace talks confirmed. However, that plays out, but the war is over. We find that out as of today. Again, hypothetical. You have your clients that are probably calling in curious to see what's going on. You talked about the game plan, but would there be any reactionary changes you might kind of advise them, or what would you do in that situation, just hypothetically?
Yeah, it's, Rich, I think that would be more than likely a massive kind of risk on
Yeah.
day, meaning stocks are going through the roof. Bond market's probably going to be rallying here. And I think overall, notwithstanding the fact that even if the war ends, there's still supply chain issues and
Sure.
infrastructure problems with decimating facilities, and the kind of the raptures of war here. But I think overall, you probably start swinging back to some of the issues that were there before the war.
Yeah.
Right? Private credit is still out there. I mean, every earnings report you mentioned, this is mid-April. We're recording this. This is the week of the big boys and girls were reporting their earnings, and private credit's everywhere. And so in terms of in the questions in their releases, there's almost $200 billion of exposure banks have directly to there. So I think that would come back, Rich, overall. So in that case, and I'm a group that, hey, rates might be coming down, but I know I have a heck of a lot of exposure to rates up.
Sure.
I got pinched really bad in 22 and 23. I'm looking at swaps. I'm looking at doing some things that make myself a little bit more term on the funding side. I'm trying to make myself a bit more neutral if I can.
Yeah.
Right. And on the flip side, Rich, if I'm the other way, one, probably wish I bought a little more bonds here. If I'm more asset sensitive, I probably wish I bought a little more in terms of over the last 6 or 8 weeks. But even then, it's just I'm making sure I'm very disciplined here and not chasing things, because right now I think the problem here is that if the benchmark rates, treasury curve, comes down, it's gonna put even more pressure on loan yields, right? Which we said was a big influence, or the asset side was a big influence this year. So now we're, if the long end's coming down, Rich, but the Fed isn't cutting, that's a bit more of a challenge, I think.
Gotcha.
Right? Overall, if the Fed is cutting, then I have the ability to offset the asset yields repricing maybe a little bit lower than I thought, because I can cut funding costs. But I think the good thing, again, maybe I should have started with this. the yield curve obviously is a bunch of short-term expectations that are set out longer term, right? So,
Yeah.
the reason why, if the long end's coming down a lot more, the expectation would be that the markets are priced against some more Fed cuts. But in the near term, you could certainly have some time here where it gets a little more volatile, and you got to be very disciplined and not overreact.
Yeah, and that makes all sense in the world. And back to what you had said before, it's just kind of being prepared and having that game plan that you can, like you said, not necessarily overreact, but react appropriately to where you stand and where you want to be. What else, Zach? Is there anything else you're hearing from clients right now, or any key themes that you think you should cover for the audience?
Yeah, absolutely, Rich. And I think this is, there's a number of them. I'll try to narrow them down here because I know that we want to be kind of concise and with what's going on, but we could talk certainly all day about it. But I think number one is well, what we are talking with clients about outside of their managing the risk position and making sure we're getting it right, and what ifing that is data. And this is not new, Rich, but and you obviously aren't a stranger to this in your line of work
Yeah.
with how much data the core has, and being able to develop analytics off it. Like we have a whole suite, right, of tools on the deposit side, the lending side, liquidity side, right, that with the whole purpose here of helping banks make decisions with all the data that they have and getting it into a format that can drive it. So
Yeah.
I think the real shift that alcos are doing a lot more of, it's not necessarily modeling out more scenarios, which we are, but it's getting more insights around the behaviors within your customer base, your member base, on the loan side, pricing, prepayments, that's, or deposit side, with decay rates and outflows and inflows and beta, right? How rates move. So a lot of this was backward looking, and we're
Yeah.
trying to, and we're taking a big leap forward to make it more forward looking with projections, with forecasts, and then we can troubleshoot it, right? We can straw man it and we can poke holes in it. But I think making this a lot more forward looking and using that data is number one, like the thing that we could talk stable coins, we could talk about other cool innovations, but like the data these banks and credit unions have and the stuff that gets isn't harnessed in decision making is really huge, and we're
Yeah.
trying to bridge that gap as an advisor to these groups. So that to me is like number one.
Yeah.
I think the second thing, and this is I find it interesting. Hopefully you do, and the listeners do too. But I think for groups this year, with the volatility that we've had, a lot of groups' budgets are probably out the window already, right? 3 months in the year, because most had some Fed cuts priced in, and as of now, they're not happening. And so
Right.
I think how to respond to that. The models may say one thing, but your budget says something else. The board approved it. Maybe your stock, and you've told the street you're going to do certain things. So I think understanding how to respond, in terms of, hey, maybe the interest expense piece is going to be higher than we thought because we're not getting the cuts. But conversely, maybe the asset side could be better. Or do we need to grow to kind of offset some of the limitations that are happening? So I think that's an interesting thing that I've already started to hear it. Well, we're behind budget. We're behind budget. We're behind budget. And I just hope that doesn't lead groups to doing things, Rich, that they're going to regret right down the road, whether it's suboptimal capital allocation, bad underwriting, or loosening some of those standards up, or overpaying for certain things on the funding side. Like every once, when you see dynamics change, people will change how they try to get things done sometimes. And oftentimes they might go outside of their wheelhouse. So I think if data is one, the second thing is just not overreaching. It's been a big thing right now, especially outside of COVID. I mean, we're almost 17 years since the last recession, or a little over, right?
Yeah.
Like the true recession. So I think a lot of folks are worried about credit. I think, and within credit comes liquidity concerns. So we're having a lot of conversations too, not only about credit and how could the private credit space move its way into directly hit banks, or what about just consumers who are bifurcated here? There's or the K shape you want to call it, where some folks are doing really well, other folks are not doing well at all. We talk through that, but a lot of this comes back to liquidity, and are you shored up as a community institution with the resources you need, and do you have the plans in place, et cetera? And you may not think you need it now, but the best time to patch your roof, Rich, is when it's sunny out, right? It's not when it's
Yeah.
pouring out and it's a hurricane. So I think that's one thing too. It might be boring. I find it interesting and exciting, but I think that's a really important piece here that we're just trying to make sure people stay ahead of, because these credit cycles happen slowly and then they happen quickly, right?
Yeah.
So
Yeah. That's a great insight there. Thanks for sharing that. Well, is there anything else we missed, or maybe even touch upon a couple topics that you have lined up for your podcast on the balance sheet, if you want to touch on anything there?
no, Rich, I'd be happy to. But first, I want to thank you and Charlie and the group. You guys have been terrific having us on. You guys do an awesome job. I don't think people realize, or listeners probably realize, how much work it takes for you folks to do the podcast as much as you do it, and put out quality content across a pretty diverse topics, kind of spectrum here. So kudos to you guys. I think you do an awesome job. And I listen. And I know my colleague who helps me, who's our co-host on the balance sheet, listens as well. But for us, I mean, I was pretty excited, Rich. We had Claudia Sam on earlier this year, economist at New Century Advisors, and she has a rule named after herself, with unemployment, and she's very, I think, humble about it. But having someone like her on in January, and the title of the show was the last Fed cut under Powell, and that was December, and she's going to be right. I think she's going to be very right about that. So that was fun, and it's a pretty interesting listen. But we have our next two. We get the 10th largest credit union in the country coming on, down in Florida, and we have like another client down in Virginia coming on in May. Who close to $1 billion stock bank. Done some interesting things, and the leader of that bank was there from formation. So I always find it interesting when you get folks, guys and gals who have, I mean, they've started banks, right? It's one thing to run a bank, but if you started it from formation, right, from de novo, those stories always fascinate me, because we need more de novos. I think we need more banks filling the voids of some of these regionals and bigger banks have kind of left for us as they've gobbled up, and there's been a lot of consolidation. So we get those folks coming on, and we always have. I know you'll be at our conference in June, which is terrific in Boston. That's still the second week or the first weekend really of June there. But we'll have Chris Lowe, the economist down at FHN, who's terrific. I'm sure you saw him last year. He's been we'll have him live, which is always a fun show. And doing that like in a hotel room was a little bit out of the studio comfort zone is always fun too. Maybe with the beverage as well. So
there you go. Yeah, that's awesome. Obviously, we appreciate the kind words. The podcast itself it's a great way to get outreach to our audience, but having subject matter experts on that are talking about different parts of the industry or trends or whatever that might be. You've been a great guest talking through what we did today, and obviously in the future, we'd love to have you back. We'll see what happens, obviously, around the world and on the balance sheet, to kind of give a little tip of the cap to you guys. But no, I look forward to seeing you guys at your event in June. It was great last year, and I'm sure it will be again. But thanks for joining us today. And again, good luck with your podcast as you move forward.
Rich, thanks so much. You guys are the best.
All right, Zach, take care. And thank you to everybody listening to today's episode on Bank Talk. Keep listening, keep learning. Thanks for joining us. Have a great day.
Thank you for joining us on the Bank Talk podcast, brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.